Last week, Silicon Valley Bank, oftentimes referred to as SVB, failed in what is considered to be the largest bank failure since 2008 and the second largest bank failure in U.S. history. You see, SVB was a bank that was considered to be the lifeblood of the tech industry. And with the downfall of SVB could come the downfall, or at the very least, a massive blow to the tech industry as a whole. And well, if you've seen my channel before, you're probably asking yourself, so what? And that's a fair question, because most of us won't be impacted by this closure, and it also doesn't have a whole lot to do with the automotive industry either. But the unfortunate truth is this SVB failure could have an impact on many different aspects of our day-to-day lives, from how our local regional banks operate, to how we borrow money, to how we finance things like homes and even cars. And so in this video, I'm going to be addressing just that, and I'm going to be talking about what I'm concerned about with this SVB closure and what I predict could be coming next. Now, for those of you who don't know what's going on with SVB, or maybe you know what's going on, but you just read some of the headlines and you don't know the nitty-gritty details, let me give you a brief Cliff Notes version of what's happening. Silicon Valley Bank was a bank that specialized in the tech industry. They were located in Silicon Valley, and they grew to the 16th largest bank over the last couple of years by lending money and handling the finances of tech companies. As tech companies grew, which was prevalent during the pandemic, SVB grew along with them. And as a result, over the last few years, SVB grew their assets to $209 billion. Now, for those of you who followed the whole FTX fiasco that happened late last year, there's actually a lot of similarities between what happened with FTX and what is currently happening with SVB. Of course, minus the fraud. And ultimately, it really comes down to liquidity, or I guess lack of liquidity. Long story short, between 2019 and 2022, customer deposits at SVB grew by 3 times, from $62 billion in 2019 to $185 billion in 2022. This is money that SVB customers simply deposited into the bank, the same way that you or I would deposit our paychecks. SVB then used this deposit money to buy bonds, which is actually very common in the banking industry as a whole. The problem, though, is that the bonds that SVB purchased actually declined in value over the last year in response to the Federal Reserve raising interest rates, which typically wouldn't be a big deal as long as SVB would have been able to hold on to the bonds until the maturity date, and it wouldn't really have mattered that the bonds in the meantime went down in value. At the same time that all of this was going on, SVB clients still needed to gain access to the $189 billion that they had deposited into this bank, because these clients needed to pay for things like marketing, payroll, overhead costs, rent, and things like that. SVB soon realized that they wouldn't have the cash to cover customers' withdrawals, so in response, they actually ended up selling these treasury bonds early, and as a result of this sale, though they were able to get a short-term cash infusion that they needed, it came at a pretty big cost, and by selling these bonds early, they ended up losing about $2 billion. At which point, SVB announced that they would be raising $2.5 billion in order to remain solvent. And well, around this time is where things really started to hit the fan, where major mainstream investors like Peter Thiel started to get involved, while companies and customers were trying to frantically take out their money. And soon after, the FDIC stepped in and said, okay, you have failed, we are taking it over from here. And that pretty much brings us to where we are today. Now, customers that have less than $250,000 in this bank are going to be fine at the end of the day, because this bank was FDIC insured, and FDIC insurance offers customers a $250,000 safety net. The problem, though, is that most of these customers had significantly more than $250,000. So there is a lot of speculation on whether or not these customers will get their money, and if so, when that will happen. Though as I sit here today, there is a lot of speculation that the federal government will end up stepping in, offering some sort of bailout either to the bank or to the customers themselves in order to make the customers of this bank whole again, which is what I think will ultimately end up happening.
And thank you for joining us tonight. I'm Natasha Zubes. We do start with this breaking news about the historic collapse of Silicon Valley Bank. Well, about 45 minutes ago, the Federal Reserve and regulators just announcing that customers should be able to access their money starting tomorrow. A huge relief for so many.
But regardless of what happens to the individual companies that have been impacted by this SVB closure, there is no doubt that this is probably going to have a ripple effect through the entire banking industry and to everyday people throughout the entire country. This may cause regional banks to be more cautious with not only how they invest their own funds, but also who they loan money out to and under what terms. This will of course have an impact on the actual companies that had money within SVB, as well as how they pay their employees, their rent, their overhead costs. There truly is a domino domino effect that could occur by such a massive bank closing. And keep in mind that as I'm recording this video, we don't exactly know what these ramifications or what the government response to this bank closure is going to be. But by the time this video goes public in a couple of days, we may have a little bit more clarity on that. But to be honest, that's a little bit beyond the point of what I want to talk about in this video. Now, when the announcement of SVB closing was first announced, my knee-jerk response, and I'm sure the knee-jerk response of many other people out there, was, man, this sounds familiar. And while there are a lot of similarities between the implosion of 2008 and what's going on with SVB today, the biggest similarities in my mind is the mindsets of the investors, the banks, the financial institutions in both scenarios. Because in both situations, there's this idea that banks, financial institutions, or the tech industry are simply too big to fail. Basically, that they could do no wrong, and no matter how big of a risk these institutions took, they would be perfectly fine. Which obviously isn't the case. And while I don't think that SVB is quite as blatant as what we saw with some of the banking institutions in 2008, I do think that it comes off of a 10-year run where tech was the hottest industry to be in the entire world. I've talked about this a lot on my channel, but there has been this idea over the last decade that tech can only go up, and whatever tech does, regardless of how poorly it's executed, everything will be fine and everyone will continue to make money. Both catastrophic failures of 2008 and today in 2023 come at a turning point of an extremely long and aggressive bull run. And while I'm certainly not smart enough to predict what's going to end up happening with SVB, it does raise some serious concerns about how this will impact other industries. My concern is that what's happened with SVB is also brewing with other companies as well. From payday loans like Affirm to subprime auto lenders like Ally to your local regional bank. Banks are overexposed with debt, and what happens whenever that debt stops being paid on? Well, banks face liquidity issues. And while SVB's downfall wasn't caused by subprime borrowers not paying on their high-interest loans, the fact is once banks begin to see a decline in revenue from the payments of their auto loan payments, their high-interest installment payments, their business loan payments, whenever these revenue streams decline, it creates a major problem for these banks. And the thing is, you don't need all of your customers to stop paying on their loans in order to create a major problem. You don't even need the majority of your customers to stop paying. You only need a small minority. And once that happens, the dominoes begin to fall. It's sort of like the old-time phrase, you only need one bad apple to spoil an entire barrel. Money supply is contracting, which is the first time this has happened in 100 years. Consumer debt is growing, interest rates are higher, and the pandemic created an unprecedented situation. And to be honest, as a result, nobody really knows what's going to happen next. My concern, and I would even go as far as to say that my prediction is that SVB will not be the first bank or lender to fail. And while I don't know who or what industry is going to be next, I do think that the car industry is coming.